All right. Well, welcome to Thursday morning. The round one for CAPSIM was completed very late Tuesday evening. You're hopefully in the process of making your decisions for round two, and then we'll do rounds 3 and 4 next week, and then we'll start the competition round the week after that. And so what I want to do on this round is really give you an opportunity to look deeper into the numbers to really understand what some of these measures really mean, and then also to start to understand a little bit more clearly how you will be graded on CAPSIM. And so you'll be able to look at things now with a little bit more detail and a little bit more holistic view than what you did in the beginning, which was essentially designed to give you a feel for the basics of CAPSIM. And now we're going to spend the next 4 rounds really talking about some more specifics. And so hopefully you can see this. This balanced scorecard is very much an example of how your grade is going to be determined. I believe I mentioned this earlier in the semester. It's not like the top team, which in this case is Andrews, gets an A, and the bottom team, which in this case is Digby, would get an F. That's not what I'm saying at all. But what this does is this gives you a sense of how you compare or how you stack up compared to others. And so certainly it is safe to say probably that Andrews and Erie, if these were the final scores, Andrews and Erie would probably earn the highest score on CAPSIM, whereas Digby and Chester would get the lowest scores. But whether those are A's or whether those are F's is determined upon many other things. But at least looking at this, you can get a sense for what you did well, where you need to improve, and things like that. And so I will show you this each week. So as we look here for an example with Andrews, give it a second. Okay, so we can see that where Andrews did well and where they can improve. Stock price certainly is decent, but there's room for improvement on profits and leverage. Same thing with some of these internal business processes. We see good scores on plant utilization and days of working capital, inventory costs. Stock out costs aren't that bad, but certainly contribution margin needs to be improved, and that's the case all across the board. And you can just take a look at this. In fact, I'll go ahead and open up each one so each team can see it. You can pause when you get to your team, just so you can see where you're doing well and where you need to improve. So we see here with Baldwin, excellent job on plant utilization. Contribution margin needs work, but again, the plant utilization, being able to forecast properly, that seems to be a strength that you had in this round. In terms of meeting the needs of your customers, not quite where it needed to be, but certainly awareness was high. And so if you can invest a little bit more in terms of your sales, that might help with your accessibility. And then just continue to work on your employee turnover, which there's ways that you can improve that as you go throughout the later round. They'll open up actually in round 2. All right, looking at Chester, and take a look here. Certainly, contribution margin and profits. That's understandable that those would be connected in some way. Utilizing your plant well, inventory was good. Looks like there's some work around how you finance your company, and then also making sure your product is available and customers are aware of it, and then giving customers what they want. Digby. Certainly doing very well on leverage, and I'll talk about leverage here in just a minute. And in utilizing the plant, margins need to be improved, and certainly as you do better at meeting the needs of your customer, having your product available, and making customers aware, that should certainly help. All those should drive your profits. And lastly, Erie. So again, a great job on utilizing your plants. Certainly there's work to be done on turning a profit, on improving your margins. Your customers are aware of your product, which is good, but there's more you can do to make it accessible okay. So let's take a look here. These are the results for round one. Each of you should have this as well. Okay, so looking at a return on sales, just to give you, I guess, a sense of how this works here. How can you improve your return on sales? Well, here's some things you can look at. Can you raise your prices? Can you reduce your labor costs or your material costs? Can you forecast better, thereby reducing your inventory carrying expenses? Have you pushed your promotion or sales budget into diminishing returns? Can you sell off some of your idle plant in order to reduce depreciation, and that shouldn't be the case early on? Or if you're not using your plant to its fullest, you can invest in automation or you can create new products. Okay, now let's take a look here at asset turnover. Really, with asset turnover, anything above a 1.3 is considered excellent, and so all of you are doing excellent in that regard. So how does this work? Well, that basically means that $1 to $1.30 of sales for every dollar of assets is considered satisfactory. So therefore, anything over about 1.3 is excellent. So let's look at where we started for all of these companies. So in round zero, each company could produce around 800,000 units on the first shift, and demand was only 1.2 million units. So half the plant was running a second shift. Sales to asset ratio was good, which increased the entire company's asset turnover. So what can companies do to improve their asset turnover? Well, certainly each of you are doing well at it, but basically what you need to do and look out for is to increase demand or reduce your asset base. And so if your plant utilization is below 130%, you can look for ways to raise that, to keep it right around 130 to 180. Somewhere around there is good. Can you make your products more competitive in terms of design, awareness, or accessibility? You can also look at your ratio of sales to assets and see if it's appropriate and if you're if you're healthy in that regard. All right, so now I want to talk about leverage. Leverage is basically saying how much of company assets are funded with debt. The higher the ratio, the more debt is in the mix. So a leverage of 2 means that half the assets are financed with debt and half with equity. Or in other words, there's about $2 of assets for every dollar of equity. A leverage of 3 is $3 of assets for every dollar of equity. So what's considered excellent is somewhere between 1.8 and 2.5. And so if we look at who's excellent in terms of their leverage, we have Ferris on the computer. Satisfactory, which is where some of the companies fall, is anywhere between 1.6 and 1.8, or 2.5 and 2.8. And so Digby is considered satisfactory, certainly on the borderline. So good job on leverage there. Just watch it, and here in just a minute I'll talk about some things you can do to raise your leverage. If you're below 1.4 or you're above 3.2, and nobody falls in that category, although Andrews is right at 1.4, that's really a sign of trouble. But if you're between 1.4 and 1.6, or above 2.8 and 3.2, that's pretty much where the rest of you lie. There certainly is much work that needs to be done. So let's just talk a little bit about leverage, how too much leverage can cause problems. Basically, as your debt increases, loans become more expensive, and therefore your company becomes high risk, and lenders eventually decline to lend you money. On the other hand, companies with a competitive advantage usually have a larger asset base than their competitors. So for example, if you have several products, that's going to imply that you have a larger plant. A higher automated facility shows that you're making investments. Growing the company asset base means that you're taking your debt and you're using it for good. So suppose Andrews has assets of around 40 million and Baldwin has 50 million. And let's assume that each team is utilizing their assets correctly. Looking at Andrews with an asset of 40 million and Baldwin with an asset of 50 million. Just looking at it on the surface, you would think that Baldwin would be doing better because of their larger asset base, and so therefore they have more products or more productivity. But let's assume that Andrews is leveraged at 2 and Baldwin is at 2.5. They both have about $20 million in equity is what that means, and so therefore Baldwin has the advantage. So what can too little leverage do? Well, it can indicate a weakness. It can show that that investment opportunities either don't exist, or if they do, you're not using them properly. So one way you can look at this is to say, okay, when a company retires debt, basically what you're doing is you're telling your stockholders that we're out of ideas for investment, and the best we can come up with is to save you interest on our debt. Now, this doesn't really impress your stockholders very much, because they're looking for a high return on equity. So an investor who's expecting about a 20% return on equity isn't going to be happy to learn that their money was used to reduce debt at 10%. They're looking for about 20%. So if a company can somehow hold its margins and productivity constant, that increases your leverage, which increases your return on equity. So what do we do if your leverage is falling? Well, basically what you need to do, and this comes back to setting a strategy in the very beginning, is you need to decide on your policy toward leverage. So for example, you can say our leverage will be 2.5, and therefore you adjust your leverage before saving your decisions. You do that by issuing or retiring debt, issuing or retiring stock, or paying dividends. You can find investment opportunities. If the market is still growing, which it certainly is here in round one, you're already at high plant utilization. Then you'll need to add some capacity each year, or perhaps you can add a new product, or you can fund these investments with a mix of debt and equity consistent with whatever policy you have. Now, as you go forward in later rounds, and we'll talk about this as you go forward in rounds even 6, 7, and 8, so don't make too much of a deal about this right now, but what you'll find is that you may have excess working capital that can't be put into good use. If you think about it, if you're in the later rounds, there's going to reach a point where making an investment or developing a new product that's not going to be available until the next round isn't going to pay off. So what you would do in the real world is certainly you would still just continue to get into new businesses, continue to invest, but since this is a simulation and it ends, what you want to do to make sure that you're leveraging your assets properly as the game goes on, you can buy back some stock or you can pay dividends in order to maintain that leverage. So that's a little bit about leverage, and that is one area that is problematic, so I wanted to point that out. Now let's just take a look at a few things here that we're seeing. Let me get down here. Okay. All right, so I'm looking at this, and I'm really seeing both this as well as what's on the fast track report. I'm really seeing Chester as being in a good position. They're a healthy company in terms of their plant utilization and their inventory. Certainly in terms of growth, we saw the most growth with Andrews and with Erie. Now, considering the market is supposed to, or that revenue should grow at around 15% each year, maybe higher, maybe lower, depending on where you are in your which segments you're targeting. Certainly, we expect that to be up by at least 10%. So if you look at sales at the very beginning, they were around $40 million. So even if you grow at 10%, you should be around 44 to 45 in this round. And Chester and Digby both failed to get to that point in terms of sales. Baldwin was close, but again, Andrews and Erie both were successful in that area. Now, one of the things with Andrews is, if you'll let me scroll down. Okay. So Andrews actually had a very high plant utilization, but they also stocked out, and so investing in capacity so that you're able to make your plant more efficient, and then certainly that would have also helped to working on your forecasting and then running a more efficient plant, that could have certainly helped to prevent some of the stockouts that you had. So earlier this week, I believe I mentioned that nobody had taken out an emergency loan. This round, we had the first company do it, which was Digby. Basically, Digby didn't sell as much days as they had thought. They and the expansions that they did make, the improvements that they did make, they funded through cash from operations, which would certainly be beneficial if you had high profits, if you had high sales, then you can take on some of that. But investing or either borrowing money or issuing stock, something that could have helped to generate money would have saved that emergency loan. However, even though Digby was certainly the ones who got the emergency loan, let me scroll back here. Erie was certainly close, and once again, Erie made some improvements in their plant, but they did not fund those improvements, and so Erie was very close. So take a look at each of those. Sorry, this is going slow. I try and scroll and it's going all over the place. Just a second. Okay. All right, so one of the things I was looking at here is why Able, which if you look at it in terms of their product, it's the lowest in terms of performance. It's the largest in terms of size, but yet they sold the most, and they certainly had the highest demand as well. And so had they had more in stock, they would have sold more. And so I was curious as to why it was that they had this product, which was the lowest in terms of performance. It was the largest in size, and it was priced right around everybody else, but yet their product sold. Well, look at age. Their age was much closer to the ideal. They also had, if I can get to it, generally a higher customer satisfaction score. And their customer accessibility was there as well. So what Able has to do now to maintain this for the next round is they're going to have to go through and make sure that that they're making their product still in line with what the customer wants, that they're keeping up with customer expectations, keeping in mind that as we move into the next round, the other products are much more in line with what the customer wants. So it'll be interesting to see what happens here in round 2. All right, so that's just a recap of round 1. I'll do this again for round 2. What I want to do as well once we move into the competition round, and I'll do it next week too, is we'll hold a live session at some point. I'll send an email as to when that will be. I encourage at least one member from each team to be there, as we'll go through and we'll look at each of these measures, and we'll talk about how each team is doing. As we move into the competition round, I'll be holding sessions as needed with each team, so we can talk one-on-one without the others knowing about some of your strategies and things like that. So with that, good luck moving forward into this next round, and we will